All right, good morning, everyone. Welcome back to the first meeting of the new year. We have Mr. Timmis joining us here today from Signature Associates. Just a little background on Mr. Timmis. He is the head of investment sales division at Signature Associates, where he focuses on sale-leaseback transactions internationally. He founded the sale-leaseback team in 2014 and has been responsible for over $1 billion of transactions in that span. But before we begin, on behalf of the Brother Rice Real Estate Club, I want to thank you for coming in to share your knowledge with us all. So please join me in giving a round of applause to welcome Mr. Timmis to Brother Rice.
Ready? That was pro intro.
Hey, thanks for the intro.
Yeah, this is Charley Henneghan. So he wasn't given enough of a heads up. This is Charley Henneghan. He runs our multifamily investment sales side of our business. He was a Brother Rice athlete, played football and lacrosse at Brother Rice, and he coached lacrosse at Brother Rice with me for 8 years. So we've been working together for 4 months, though we've been in the industry for a decade. So, but today I wanted to talk a little bit about what we do. We do real estate or commercial real estate investment sales, which is kind of the broad category. So we don't find space for people, right? So if someone wanted to open up a bar downtown, I'm not your guy for that. If your dad had, needed 100,000 square feet for new distribution capacity, I'm not your guy to find that space for him. Although I'd love to do a deal that size, it's just not what I do. I don't sell land. I don't have my sign on buildings, so you won't be driving around seeing my sign or Charley Henneghan's sign on a building. We do strictly cash flowing real estate, and the way the cash flowing, what's up, Ray? The way the cash flowing real estate gets sold, Dario, got a bunch of late boys in the back. The way the cash flowing real estate gets sold, it doesn't get sold by someone driving by and saying, "Wow, a 13.76% return. Wow, that looks great." It's not like that. It's more sold on the internet and sold in a totally different fashion than like an empty building would sell. So I'll tell you just first off, just kind of how I was drawn to the industry and really real estate investments in general. So I'll throw kind of a little like a riddle or a quiz question for you. Or just something to think about. You can buy a building for $1 million, sell it for $1.3 million and double your money. I'll say that math again. You can buy a building for $1 million, you can sell it for $1.3 million, and you can double your money. Does anyone know how that's possible?
Like the down payment you put down, that's for your doubling?
Okay, so you're getting somewhere. You're getting somewhere.
Yeah. Taking a loan on it or selling a contract to the building?
Well, no, not selling the contract, but you're getting somewhere.
So
Both.
you're taking a loan on it.
We're taking a loan on it, but now do you know the math of it?
Interest.
No.
You pay your loan back in full, right? You take something you know you can pay off, sell it, and then pay it off.
You two are very, very. You either understand it, but not well enough to explain it yet, right?
Yeah.
But you guys get it. So you buy a property for $1 million, okay? You take out a $700,000 loan from the bank, okay? Okay, so Charley and I, we put together $300,000. We put $300,000 down to buy $1 million building. We get $700,000 from the bank. That's not our money. That's the bank's money. The $300,000, that's our money. The $700,000, that's the bank's money, right? We go and buy the building for $1 million with our $700,000 and our $300,000, right? Say a week later, we get an offer from Urema, big dog. He comes in and says, "I want to buy your property for $1.3 million." And we say, "Okay, great, we'll do it," right? So in theory, he gives us the $1.3 million. We got to pay back who?
Bank.
The bank. What do we owe the bank?
700.
That's right. So 1.3 minus 700 is what? 600, right? So we cash out with 600 net, right? What did we put into it?
300.
So we doubled our money, right? So we bought a building for $1 million. We sold it for $1.3 million. We doubled our money. That's a pretty cool concept, right? So I kind of loved that idea. It was like, wait a second. You can buy a building for $1 million, sell it for $1.3 million. I could double my money. Now let's magnify it, right? 10 million to 13 million, or 100 million to 130 million, right? So those are kind of the ideas. Like, man, shit, you can make a lot of money in this business just by taking out leverage. Now leverage, it's a dangerous thing too. And I say leverage, I mean debt, I mean loans. It's all interchangeable words, right? Leverage, debt, loans, credit, it's all the same thing. It's debt, right? And debt can be dangerous, but debt can also enhance returns in the way that I was just explaining to you, right? So that's kind of the idea that was sort of drawn, that made me mathematically drawn to this industry. But then I realized pretty quickly that's really not like how most people make money in real estate. It's not about like buying low, selling high, buying low, selling high, buying low, selling high. It's not how most people make money in real estate. Most people, they create portfolios. They develop a niche of some sort. They're, whether it's multifamily or it's industrial or it's hotels. They stick to that niche and they build a portfolio. They create economies of scale. Do you guys know what economies of scale is? It's economies of scale is like when you buy more of something, right? The price per pound, the price per whatever goes down, right? When it comes to like business, economies of scale is, the more hotels that you buy, the more management scale that you have, right? If you buy a bunch of apartments in Birmingham all on the same street, you can hire one guy to do the landscaping for all of the buildings if they're all on the same street. You get what I'm saying? Rather than if you have a building in Romeo and a building in St. Clair Shores, a building in Grosse Pointe, and a building in Birmingham, you're probably going to have 4 different people cutting your lawn. You get what I'm saying? So you get a little bit of scale, what we call scale pricing, when you kind of expand your portfolio in a concentrated part of regionally concentrated. So, but that's kind of some of the ideas that kind of got me drawn into this. Now, I specifically do sale leasebacks. Okay, so while on one side of my business, my personal side, I invest a lot of money in real estate. But if you're going to invest money in real estate, you got to make money somehow, right? And so my business, the vehicle that makes me money or enough money to go invest in real estate is I do sale leasebacks. So I go after businesses that make tires, businesses that make ties, businesses that make furniture, or I did a cookie factory recently, a cookie bakery, I should say. And what I do is I go to them and I say, hey, listen, you make cookies, right? And you guys are expanding and doing really, really well. You have this $5 million piece of real estate. You shouldn't own that. You're not really in the real estate game. You're in the cookie making game, right? And so what I do is I go to them and I say, hey, you should sign a long-term lease and we'll sell this $5 million building for $6 million, $7 million bucks because you're signing a 15-year lease on it, right? And you can then take that money and inject it back into what you know best, which is cookies, right? And so with this particular company, it's called Ellison Bakery. It was in Fort Wayne, Indiana. For them, they're growing like a weed. Industrial real estate value doesn't necessarily go up like Naples real estate value does or like Charlevoix real estate value does. It's pretty stagnant, industrial real estate for the most part. So for a lot of these folks out in places like Fort Wayne, it makes sense to sell out of the building, sign a long-term lease, take those proceeds and inject it back into the business. So what Ellison Bakery is doing with those proceeds, they ended up buying rival cookie companies, right? So instead of just leaving the money stagnant in the real estate doing nothing, the business is taking the money and going offensive with it, and they're buying a bunch of smaller cookie companies to create economies of scale, right? And so that's what I do. I do sale leasebacks, usually in and around M&A events. You guys know what M&A is? Mergers and acquisitions, so like businesses buying other businesses, right? So usually my transactions are associated with some sort of business gobbling up another business, right? And that business might have real estate. They know that the money being in the real estate, if you're in the cookie game, having your money staying dormant in your real estate isn't necessarily the best use of the capital, so they'll sell out of the real estate. They stay there. They don't leave. They stay there. They sign a long-term lease, right? And then an investor purchases the building. Yes, sir?
Yeah, so they sell it directly to you, and then they pay you.
Yeah, I don't buy it, but I'm a broker.
Okay.
Right? So I broker it, right? And
Yeah.
so typically I'm selling these buildings to real estate investment trusts.
Yeah.
They're called REITs. You guys know what REITs are? REITs, R-E-I-T. So here, we'll give a little concept here, right? You got a building, right? The building, inside the building, there's cash, right? The building is worth something, right? But if the building isn't sold, you never realize that cash, right? Over here, so this is owner, right? This is cookie company. The building then gets sold to who? It gets sold to a REIT. A REIT is a real estate investment trust. Typically, they're publicly traded. Okay, so you can go on, Yahoo Finance or whatever and find their ticker symbol, and they're traded on the New York Stock Exchange. The REIT got lots of dough, right? They also have a lot of properties, lots of properties. So they're diversified across, hundreds of different properties across different markets, different tenant businesses, etc. So they're pretty well diversified. The REIT comes in and buys this building for, let's call it, $7 million. Right? The owner gets the $7 million. They now start paying the REIT, call it, 500 grand a year in rent. Right? But now over time, they'll supersede that $7 million, if it's a 15-year lease, right? But really, $1 today is worth more than $1 tomorrow. If you're an investor, you'll learn that someday. $1 today is worth more than $1 tomorrow, right? And if you are making 10, 11, 12% on your money, or 15, 16, 17% on your money is better used buying the rival cookie companies than it is staying dormant in the real estate.
So then you would take a percentage of selling it to the REIT?
Yeah, for me on a $7 million deal, it'll be like, 4 or 5%.
Yeah.
Something like that. Yeah, that's kind of how it works, right? The owner sells the REIT buys the property, and the owner is leasing it back. They're not leaving. They're not finding more space. They're not leaving the building. They're leasing it back to the investor, right? So, Aiden, what's up?
So you're basically just the middleman in this process?
That's right. Yeah, exactly. Right. And a lot of times I'm literally just shining light on, like, here, I'll give you an example. You'll love this. Well, you might or might not love this, but you guys love, like, other stuff. But, so I just did a presentation for a company called Caterpillar. You know Caterpillar? You guys ever heard of them? They're so huge. It's like big publicly traded company. I think they do like 170 billion in revenue or something like that. But I just did a presentation for them. They own a bunch of real estate. Like billions of dollars of real estate. And I just did a presentation for them as why they should start considering doing sale-leasebacks. And they're like, no, we don't need the money. And I'm like, no, it's more just kind of the mathematics of it. And they said, well, explain. And I said, well, here. And I wish I could show you this like online, but like I basically pulled up their stock, Caterpillar stock, and I ran a 10-year analysis from 2014 to 2015 to the present. And you see the Caterpillar stock was something like that. It just absolutely dominated the last 10 years. Then I took just the general commercial real estate index line, right? So there's like, you can look at these little indices on Yahoo Finance. So like there's an index for everything. There's an index for hotels, there's an index for automotive industry, there's an index, it kind of gauges the performance of that particular industry. And so I took so this is the Caterpillar stock, right? That's the performance. I just kind of tracked it over 10 years. And then I looked at the general commercial real estate index line. And that line looks something like this over the last 10 years. Right, so I kind of highlighted just the difference, like, here's how your company did, here's how commercial real estate has done really for the last 10 years. And so, while they're saying, like, I don't need the money, why would I do a sale-leaseback? I'm like, no, dog, you should just sold, $80 billion of the real estate, or whatever the hell they own, something like that. It's something crazy. It's like they own, call it $10 billion of the real estate, right? Bought all your stock back, and just gone to the moon with it. That's what you should have done, rather than leaving your money stagnant in the real estate doing a whole lot of nothing. Like in 2014, 2015, you should have sold out of it, signed a long-term lease, put in your stock, and it would be worth 10 times that. which was interesting for them, kind of them hearing that sort of perspective. So for the most part, what I'm doing, these are industrial buildings, right? So if I'm sure the Colliers guys came in here, didn't they?
Yeah.
Where's Kepik? Is he here? What a bum, right?
He's usually here.
Yeah, usually here, total bum. But they talk about industrial at all? Yes, a little bit?
Yeah, a little bit.
You guys know what industrial is? Industrial real estate?
Like factories.
Factories, warehouses, manufacturing, right? So that's mostly what I'm selling are factories, like manufacturing and distribution, warehouses and stuff like that. Now I've done my fair share of retail and other things like that, like auto repair, but for the most part, it's all sale leaseback for me. Now, what's interesting, and I'm gonna this would be a good kind of shift here. Who knows the four major, what I call food groups, the four major property types? Dario, you know? Wechter, you know? Yeah, we know you don't. Well, let's start. We just mentioned one, right? Industrial, okay. So that's one property type. What's that? Residential. Well, we're talking in the commercial sphere right now, right? So residential single-family homes, yes, but that's its own real estate ecosystem that I'm not in.
Multifamily.
Multifamily. Very nice, Brady. Okay, so that's number two. So you got industrial, you got multifamily. My man's. Specialty real estate, like what? I kind of like that. Yeah, that's very nice. It's that is, I wouldn't call them the four major food groups. You're almost like at the 201 level class. I'm still at 101 right now. That's good stuff. What's your name? Sebastian? All right, cool. So, guys, two easy ones, right? We got multifamily, we got industrial. What are the two other ones? Think about like restaurants. What's that called? Retail. That's like Hanawa's, Hanawa's got retail, A lot of Chaldeans, they love the retail. And then what's the last? The worst asset class of them all. The one that's just dying. Office is getting absolutely killed. Have you guys heard this?
Yeah.
What's going on with office right now?
No one's going to their office.
No one's going to work, right? Yeah. It's office is absolutely dying, right? Retail, depends which kind of crevice you're looking in, but some of retail is absolutely dying. Do you guys know which type of retail is dying?
Malls.
Who said it? Yeah, like stores. Tate, pretty good. So, but think like big box stores. When we say big box, I'm thinking like Macy's, JCPenney, stuff like that, Lowe's. Those things are doing, those concepts are struggling. However, is McDonald's struggling? No. Burger King's? No. Maybe, I don't know. Those fast casual dining, Panera, stuff like that, like that's not, right? And then even shopping centers, a little shopping center, like is the Plum Market Center, is that dying? No, right? So it depends which avenue you're looking in, right? But some of retail is dying because of what we call the Amazon effect. Yeah, exactly. So office, most office is dying, but there's some office that isn't dying. Like I just did analysis for a guy that does boob jobs. Great business, thriving in Birmingham. That's the type of office. Medical office has actually done quite well, right? Especially like surgery centers, right? It's done really, really well. So you can't put a blanket over everything. However, in my opinion, right now, the two safest asset classes that you can be in as an investor are industrial, which is kind of what I'm selling, industrial sale leasebacks, but industrial just generally speaking, and then multifamily, which has historically always been kind of like the safest asset class. So I think it makes sense for you to kind of describe maybe a little bit what you do.
Yeah. So I'm a multifamily guy. I've been a multifamily guy for about a decade now. I've done about $6 billion worth of transaction volume in my career so far. And yeah, a lot of people get confused when they talk about multifamily. They say, hey, is that residential? And the answer is yes and no, right? So I'm dealing with properties that house people, right? They pay rent to live there. So from that perspective, it is definitely a residential situation. But I sell these deals on behalf of the owner who owns the entire building, the entire community, the entire high rise, whatever it is. It could be 4 units up to 1,000 units, right? other subclasses within multifamily, not to get you too confused here, but you have manufactured housing, mobile home parks, right? That's one. Hospitality, somebody mentioned hospitality earlier. That could be considered multifamily. Affordable housing, you know, which is rent subsidized. The government's paying a portion of the rent. So yeah, there's food groups within multifamily. Senior housing, right? But for me, I specialize in market rate, straight down the middle, multifamily housing. And yeah, and many people consider it the belle of the ball. Lately, it's been industrial. The past 2 years have been a struggle on the multifamily front. To give you guys an idea of what the trends have been in my business, in 2022, we did $1.2 billion in transaction volume. It was an unbelievable year. The year before that was actually more than that. In 2023, as the interest rate environment started to tick up, our transaction volume dropped to $350 million, you know, which was a huge drop off. And then 2024, ultimately our team finished under $100 million in transaction volume. So, you know, for me, transactions are a product of the interest rate environment, the 10-year treasury yield. You know, these are things that you'll learn as you go. That's 401.
Yeah. For sure.
But yeah, that's just and again, just like Luke, I'm the middleman. I'm not buying the real estate. What I'm doing is I am basically going into a contract with the owner of the real estate to go find a buyer for the real estate. I'm the middleman. I charge.
Now, Henny, so I mean, you know, he said like, you know, multifamily is in a tough place. It isn't. Multifamily as an asset is crushing it.
Right.
It's doing great. If you own multifamily, you're doing great, right? If you're a broker that sells multifamily right now, it's tough because interest rates have gone up. So,
the metric.
I want to get into 301, 401.
Right. Yeah. The metrics are great. Like in general, the industry is about 95% occupied plus, which is great. Rent growth is stable at roughly 2 to 4%. Great. Like everything's going fine. There's no big issues from that perspective, but transactions are in a tough spot because of the financing situation.
Yeah, I don't throw them off with that because like multifamily is such a great asset class to be in. It's interesting. It's one of the most risk-averse real estate asset classes that you can be in. Number one, because of we call turnover risk. Wachter, what is turnover risk? What does that mean?
Risk where you can lose it all.
Like my deals, for example, I do sale leasebacks, right? I call that binary risk, right? It's like you got this one tenant.
One space.
Yeah.
Under one
Bob's
roof.
Furniture or something, or Joe's Furniture in St. Clair Shore or something like that, right? It's like, if that's your tenant, they're either there paying you rent or they're not. So it's either 1 or 0, I get that binary risk, right?
Yeah.
However, if you own, like my brother and I, we own 21 apartments in Birmingham. There are 21 units in Birmingham. If I lose a tenant, I'm 20 of 21, right? I'm still like 90-something% occupied, right? If I lose two tenants, I'm still 90% occupied, right? Plus I'm in Birmingham, so this stuff doesn't stay vacant for very long, right? It leases up pretty quick, right? So the turnover risk in multifamily is very, very low, right? And it's because it's hedged across, many times hundreds of units,
thousands
of units in some cases, right? Whereas if you're buying single tenant properties, if you're buying McDonald's or you're buying Walgreens or Rite Aid, which just got smoked, you got that binary risk. Either they're going to be there or they're not, right? So I always say like, hey, if you go and you raise $10 million to go buy $50 million of the real estate someday, like your brother is going to do someday, you'll probably do it with them. If you choose to go buy some single tenant stuff, dude, diversify quick, buy a lot quick. Meaning, get the Bob's Furniture, but also get the auto repair, also get the restaurant, also get the industrial building, also get You know what I'm saying? Get the cookie bakery, so now you're diversified across different geographic areas, you're diversified across different tenant industries, you're diversified across different property types, right? Whereas if you you just buy one Rite Aid, right? The Rite Aid, which just went bankrupt, right? Did you guys know that, right? I went bankrupt. Yeah, so you know, if you just own one Rite Aid, you've got this binary risk where you could, you know, get effed, right? So diversify quickly. Now with multifamily, like you buy one 100 unit deal, you can feel pretty good about that diversity.
Yeah, so it makes it super attractive to investors and ultimately the belle of the ball. Another component that adds to the attractiveness of multifamily in general is the forecast as it relates to renters versus owners, right? Property values on single family homes have gone up and up and up at a staggering level. Less and less middle class Americans have, you know, 40 grand lying around to go put a down payment on a house, right? A lot of people are paycheck to paycheck. So in the long term, many investors believe that the rental market is going to be absolutely beautiful because of the fact that nobody's going to be, not nobody, but less and less Americans are going to be able to afford owning their own home, right? So that's another component that adds to the attractiveness of the
there's also the recession proof. So it's a recession hedge, I should say. I should say recession proof, but people think of multifamily as being a recession hedge, kind of hedge your bet, right? So, what was I saying? My bad, Brady. All right. So with multifamily, you've got this recession hedge sort of idea where, okay, when shit hits the fan and the economy goes bad, what happens, guys?
Lose money.
What's the first thing that happens?
Oh, people mortgage their houses.
Well, before that.
Value goes down.
No, don't even think real estate wise. Like when shit hits the fan, economically speaking.
People get fired.
People get fired. My man Fish. This guy. What a weapon. Front seat. Right? Total weapon. So people lose their jobs, right? What happens when they lose their jobs?
Can't pay their rent.
Well, they're not getting paid,
Yeah.
right? So if they're not getting paid, a lot of people can't pay their mortgage. And if you can't pay your mortgage, what happens?
Foreclosure.
You lose your house.
when you lose your house.
You become a renter, right? And so weirdly enough, when shit hits the fan in the economy, people lose their jobs, they stop getting paid, they stop paying their mortgage, they lose their house, and then, this is weirdly enough, multifamily apartment buildings, occupancies go up, and rents oftentimes go up, because there's more competition for that space. Isn't that crazy? So multifamily is a very interesting, risk-averse sort of product. If you are a real estate investor and you want to go the safest route,
Yep.
kind of, but it comes with its headaches.
Yeah,
though.
exactly. It
Yeah.
comes with headaches, and it comes with a, you know, I don't know how much you guys know about cap rates.
See, I don't.
They don't,
thing.
not a damn thing, but,
401.
yeah, but the lower the cap rate, the higher the price. My industry typically comes with, 200 basis point delta, so 2-point cap rate
Made you think
compression. Yeah, anyway, yeah. Yeah. So anyway, it's a lower cap rate to get into my business than it is any other 4 food groups, right? Higher cap rates in the other 3, lower
Yes,
cap rates in mine, right?
Low risk,
Yeah.
low return, right? We
Yeah.
talk about cap rates, just talking about returns, right? So
Yeah.
anything low risk, low return,
Yeah.
right? Multifamily is like just about the lowest risk that you can get. It means it's gonna be a lower return when you buy it. So you buy, it's gonna be, in his world, the cap rates are like 5 or 6%. Like they're super low,
Yeah.
right? Meaning you're making 5 or 6% on your year one investment. Right? It's pretty low, right? Like the shorts could do better, probably do better than that, within the first year. But the idea is to buy and aggregate and create economies of scale so you can beat that 5%, right?
Yeah, and economies of scale for me, just like you mentioned before, if you have a bunch of units on the same street, it goes a long way. But if you're in Philadelphia and you want to diversify into Michigan, you're not going to buy one 50-unit deal on location from Philly, right? The only way those types of groups enter Michigan in our market is they go buy 1,000 units at a time. That's the only way they can actually get into these types of markets too. So,
Right.
economies of scale is huge for managerial efficiency in my business as well.
And
Do you go out and find people, or do they come to you?
they come to you.
Yeah, they come to me a lot. They come to me a lot of the time, but at the end of the day, we're putting ourselves out there and.
But you're not like a hired gun to go underwrite deals for investors.
Right, exactly. Yeah, absolutely.
Right?
No,
Like
yeah.
you have a seller that wants to sell his apartment building. This is kind of where it gets interesting. It's like this is where like kind of both our worlds collide.
Hop in.
And this goes for just generally like investment sales, right? Like, we'll take multifamily out of it. We'll just, again, just broadly investment sales. So let's talk about a piece of real estate that we're all familiar with, right? Plum Market. We all know where that is, right? What's the crossroads? Right. Do you guys know who owns that?
Jonas.
Nice. So, that building, if they want, right, the anchor tenant is who? What's who?
Jonah, right?
Well, the tenant though is Plum Market, right? That's the anchor tenant, right? That's what's bringing in the most of the foot traffic. That is your Trojan horse, and then you've got all these inline tenants, right? Which would be like the Buddy's Pizza, and, the Stroh's, exactly. What's that? Jersey Bagel. Yeah, it used to be Subway back in my day, but. So if they ever wanted to sell that building, they wouldn't just put a sign out in front that says for sale. Okay? It's just not how those buildings get sold. That building is not worth the bricks and the sticks and the roof and the, how do the windows look and how many bathrooms are there. That's not how you do the valuation, right? That Plum Market Center is valued based on the cash flow that it produces, right? So Plum Market pays rent, right? Whether it's to themselves or to, but they're paying rent. Okay, Stroh's pays rent, right? Across the street, Ember's Deli is paying rent, right? So the property is being sold based on the income that it produces. So you wouldn't just hire some realtor to sell that for you, right? You got to hire someone that understands really like investment banking, knows discounted cash flow modeling, understands how to model out future cash flows in Excel and convey it to the investor world, right? And so that becomes kind of a more select group of people rather than just some guy who has his real estate license, right? So yeah, from a valuation standpoint, it's a little bit more complicated. It's not like, yes, the roof was replaced in '23, and we've got 116 parking spaces, and the ceiling heights are 14 feet. It's not really how we sell buildings. How we sell buildings is, the property is 96% occupied. The anchor tenant is Plum Market. Plum Market pays about call it $500,000 a year in rent. Right? They reimburse for real estate taxes, insurance, maintenance, etc. Stroh's is paying about $12,000 a year. Much smaller, right? And Jersey Bagel pays $26,000 a year, and etc. So you add up all those rent numbers, right? Then what comes up once you've added up all the rent? That gives you your total revenue for the building, right? What comes after that?
Your profit.
Well, you're cutting to the chase, my guy. This guy's all about profit. He is all about his
Your
money.
costs and your tax.
That's right, your costs, your expenses.
Yeah.
Right, your expenses, right? So you mentioned one. You said your cost and your?
Tax.
So we're gonna call them expenses,
Okay.
right? So expenses, the largest expense line item in any real estate profit and loss statement is your real estate tax. Right, so that's always the first expense. So you got all your revenue. Your revenue is what? What does revenue comprise of?
All of it. All
Like
of
your-
it.
all your
Everything,
income.
all money.
From all the tenants.
Thank you, Dario. It's rent. It's just rent. Revenue is rent, right? So rent, you got all your cumulative rent at the top, right? Then you got real estate taxes, right? Then the next expense, maintenance,
Yeah.
right? You got to maintain your building, right? Repair, we'll call it repairs and maintenance, right? Third line item on the expenses, insurance. You own a house, you own a boat, you own a car, you own a piece of commercial real estate, you got to pay insurance on it, right? Then property management, right? You might not want to be the guy changing light bulbs and doing the toilets and whatever, chasing people for rent. Yeah, exactly. When Stroh's is late, not saying they are, I'm just saying, when a tenant is late, going and chasing them for that rent is not easy, right? So you got property management, and then maybe utilities, right? Where are utilities?
Lights.
Yeah, exactly. Water, gas, electric, exactly. So those are the expenses that detract from your rent. And then ultimately it gets to my man, what is it? Profit, but we call it NOI. Net operating income, right? NOI, that's a good term for you guys in a real estate club. Urima's got no notes out, you know, Wector's on his laptop or whatever, but if you can remember one thing, this would be a good thing to know. The profitability metric in investment real estate is called NOI, net operating income, right?
How many people knew that?
Oh, Fish, this guy is just a weapon, man. Look at him. Or is he just a little nerdy teacher's pet? We're not sure. No, I'm kidding.
That's a big baseline, boys. That's where it all stems from.
Yeah, exactly.
That's
We
where
are
it is.
solving for what?
NOI. Every
Yeah,
day.
that's what we're solving for. NOI. What is the property shooting off? Right? What are they shooting off in rent? What do we got paying taxes, insurance, maintenance, utilities, property management, CapEx reserve, etc. And then what's our bottom line? What is this thing doing? Right? And, you know, kind of the last point here, right? Because I got to be getting close here, right? Or no?
Yeah.
How much time do I have, Meech?
7:40, 45.
3 minutes?
3 minutes?
4 minutes.
Give me 5. How about 5? 4.5. Okay. Okay. Here's the idea, boys. This is it. So we started off with this concept of, you know, buy for $1 million, sell for $1 million, 3 double your money, right? I've done that before, but it's not how it's going to work on every deal. Okay. Here's the idea, right? Is you're making your rent, right? We're gonna say is 100. We're gonna say it's 1 million is your rent, right? Then so that's your rent. Then you've got your expenses, right? We're gonna say that that's 500,000 just total, right? I'm just kind of cutting. I'm not gonna itemize it all out, right? What's this profitability metric here?
500,000.
No, what's it called?
Oh, I don't know.
NOI, boys, let's go. NOI, right? What is it? 500 grand. Nice. Okay. So we've got that NOI. Now, when we buy a property, so let's just say we're buying this property for $5 million, right? Me and the Shorts Bros are buying this building for, or should I say, the Shorts Bros and I. We're in a classroom right now. Buying the building for $5 million, right? What's our loan? Who's gonna be our lender? Urima. What's our loan gonna be? How much are you willing to lend us on our $5 million deal? 300,000?
Million, or no,
300 million? I'll take that.
That sounds like a great deal.
3 million?
3 million.
3 million? Okay, he's gonna lend us 3 mil. All right, cool. Urima Debt Fund is giving us 3 mil, right? So the asset value is what? 5 mil. Debt coming from Urima Bank, 3 mil. What's the money that me and the Schwartz Bros got in this? 2 mil. 1.9 of it is mine. The other 100 grand is their dad's. What's up? Here we go. Right, we call that equity. That's our money, right? So this is kind of how we structured the deal, right? We bought a $5 million piece of real estate. We got a $3 million loan. We got $2 million of equity. Right, it's a mix of mine and their money, right? Now, when we're looking at the NOI here, okay? So now we've got this interest payment, right? So on the interest on the debt, right? Urima's not just gonna give us $3 million and say like, you're good for it, my Rice brother in Christ. You know, it's not how it works, right? You gotta make some money, right? And so we're gonna call it, we're gonna say it's a 6% interest, right? 6% of 3 million, who's got that? Who can do that in their head? Weak. All right, 6% of 3 million, 6 times 3 is what?
50K.
Hold on, 6 times 3 is what? 18, so 180 grand. 180 grand is we'll call it the interest, right? 6 times, right? And your net profits, as we call it net cash flow, after debt service, right? Ends up being $320,000, right? You see that? 320, 180 equals 500, right? 320,000, that's what we're making, not NOI, it's actually after debt, because we gotta pay Urima too, right? Urima makes this chunk, right? Okay, net cash flow is what? How much did me and the Schwartz Bros put in? 2 mils. What's our return? So like over 10%. It's pretty good, right? Okay, so that's kind of if we didn't take out debt, okay, if we just bought it all cash, right? We would have just paid $5 million for the thing, right? And we would have made what? 500 grand. We would have made 10%. You follow? When you add debt to the equation, okay, we got a loan from Urema. We're paying them $180,000 of interest a year. Boom, we get down to $320,000 of net cash flow, right? So that's kind of the real profitability metric if you've got debt in the equation, right? So $320,000 divided by 2 million, right? Because this is what we're looking for. What's our return on the equity? What's our return on the money we're putting in, right? 320 divided by 2 million. Who could do that in their head?
15%.
15%, something like that. It's probably a good guess. Yeah,
That's too much.
maybe. Let's just pull out the calculator. I was gonna. 320,000 divided by 2 million. 16% fish. So 16% return if you add some debt to it. 10% return if you go no debt. If you go no debt, you never get burned though. Right? So people get burned all the time with that. So don't forget that, guys. All right, that's it, right? That's what we got?
So, you guys, I'll send out Luke, we'll get some email addresses out if you need them. We're gonna try to get these guys to come back, because they got a lot to talk about.
Yeah.
Would you say Luke's pretty good at conveying it? That's high level stuff.
Yeah, we went to 301 pretty quick, but it was good though. Good guys.